Good morning, everyone. The main theme yesterday was attempts by Eurozone officials to talk down the single currency. It started with EU Commission Vice President for Industry, Antonio Tajani, who said the single currency at 140 hurts the economies of Spain, Italy, France, and in the long run, Germany. This was the first comment we've gotten from the EU Commission about the euro-dollar rate. Then Bundesbank President Weidmann said the bank could use negative interest rates to prevent the euro from strengthening further, and that quantitative easing wasn't out of the question to combat deflation. That's significant for two reasons. First off, Mr. Weidmann is the most hawkish ECB member, and if even he's getting concerned, it means there's a general consensus. Secondly, it corroborates comments from ECB President Draghi that the currency rate, although strictly speaking not a target of the ECB, is nonetheless becoming a concern for the bank. Then another council member said the bank is preparing additional measures to avoid deflation and that he wouldn't oppose quantitative easing if needed, which put further pressure on eurodollar. Overall, though, the amazing thing about eurodollar is its stability. Even after all that, eurodollar had less than a 1% range on the day. Looking at the rates we take every morning, eurodollar has had either a 137, 138, or 139 handle, except for one day, for the last 28 working days. That's a remarkably narrow range, considering that the period includes the Russian invasion of Crimea, an FOMC meeting that changed everyone's view on the outlook for interest rates, and the first ever default by a Chinese corporate bond. I think years of zero rates and quantitative easing have made investors confident in the ability of the central banks to manage events, but what happens when several central banks start normalizing their policy? Then we're likely to see greater differentiation among currencies and the return of trends. Today starts with the German GfK consumer confidence for April, which is forecast to remain unchanged. Then we've got Italy's retail sales and consumer confidence. They're expected to be up somewhat, but these indicators aren't particularly market moving. In the U.S., durable goods orders for February coming out. The headline figure is expected to have risen 0.8% month on month after falling 1% in January. On the other hand, the rise in orders for durable goods, excluding transportation equipment, is expected to have slowed to 0.3% month on month from 1.1% in the previous month. So I think that figure could be mildly dollar negative. Also, the preliminary market service sector PMI for March is coming out. That's also probably not going to be market affecting. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, Global Head of FX Strategy at IronFX Global, wishing you solid trading.